Nigeria was Africa's largest economy by GDP for years, a nation with enormous oil reserves, a huge domestic market, one of the continent's most influential financial sectors. At its peak in 2014, Nigeria's economy was valued at around 570 to 580 billion US dollars, thanks largely to crude oil exports. Today, although figures vary with exchange rates and, different methodologies, nominal GDP has fluctuated a lot, and real growth has really weakened. Real GDP growth slowed from about 6.3% in 2014 to under 3% in recent years, and even as the population grew rapidly, that meant output per person basically stagnated or even declined. The central fault line in Nigeria's crisis is really its continued overdependence on oil exports. Oil actually accounts for roughly 90% of export earnings and around 65% of government revenue, but it contributes only a relatively small share of total GDP because the rest of the economy, that is manufacturing, technology and agriculture, never really industrialized at scale. When global oil prices began collapsing after 2014, Nigeria's government revenue just plummeted. In 2014, crude was trading near $100 per barrel. By 2016, it was nearer $30 per barrel. That deep price shock wiped out billions in income and left public finances, really vulnerable. This dependency became its downfall when the country went into recession in 2016, with GDP growth diving into negative territory. Manufacturing firms, already competing with imports, faced weakened local demand and a collapsing Naira. Foreign investment dried up as inflation surged and confidence in macroeconomic policy rapidly evaporated. A second structural failure was exchange rate and fiscal policy mismanagement. For decades, Nigeria operated multiple foreign exchange windows, artificially supporting the Naira's value and depleting reserves. In mid-2023, the government under President Bola Tinubu unified the exchange rate and allowed the Naira to float, which, honestly, caused it to lose significant value. In some reports, from roughly 750 Naira per US dollar to over 1,500 Naira per US dollar in late 2024. This sharp devaluation made imports far more expensive, fueling inflation and squeezing both households and businesses. The removal of fuel subsidies in 2023 was another major turning point. Subsidies had been costing the government hundreds of billions of Naira monthly. Their elimination was intended to free resources for development, but it also triggered sharp increases in fuel and transport costs, which passed through the economy into food prices and other essentials. Nigeria's inflation spiked to levels not seen in decades, with some estimates showing inflation above 30% in 2024 before trending down slightly. These macroeconomic shifts hit people's bank accounts and businesses. Purchasing power declined as the Naira devalued. Imported inputs became more expensive for firms, and companies in sectors like manufacturing, construction and retail saw margins compressed dramatically. Firms unable to hedge against currency risk reported margin declines of up to 30%, according to some business analyses. Foreign direct investment also collapsed. In some quarters, Nigeria reported FDI inflows of under $30 million, a tiny fraction of total capital flows, and a sign that investor confidence was weak. Another long-running contributor to stagnation is insecurity and infrastructure underinvestment. Conflicts in agricultural regions, banditry, and persistent challenges in maintaining critical transport and power networks have eroded productivity. poor electricity supply and, inadequate logistics really constrain domestic manufacturing and raise costs for companies like Dangote Group, Guarantee Trust Bank, Zenith Bank, and MTN Nigeria, all of whom require reliable energy for their operations. Fragmented rail networks and congested ports add hidden taxes on every traded good, making it harder for Nigerian firms to compete both regionally and globally. The COVID-19 pandemic further exposed these structural weaknesses. Nigeria briefly entered recession again in 2020 when global demand collapsed and petroleum revenues vanished. Lockdowns disrupted domestic supply chains and remittances from abroad as well. Fiscal fragility has also played a role. Nigeria's tax-to-GDP ratio has been low, under 10% of GDP, meaning government revenue was always tight relative to expenditure needs. With oil revenues becoming volatile, the state has borrowed more from domestic and international markets to finance budget deficits, pushing public debt higher even as economic growth remained weak. However, recent reforms, including the unification of the foreign exchange rate, the removal of subsidies, and stronger tax administration, have helped stabilize parts of the economy and rebuild foreign reserves. In 2024, Nigeria experienced its fastest annual growth in about a decade, with a 4.6% expansion in the fourth quarter, according to the World Bank. Fiscal deficits narrowed as revenue improved, and the Naira's unification helped restore some investor confidence. However, these reforms have also pushed up inflation and the cost of living, illustrating the trade-offs between stabilization and social pain. The human cost of these macroeconomic choices is, honestly, profound. Estimates suggest that over 125 million people, that's roughly 60% of the population, live in poverty, and this number has risen alongside inflation and weak wages. Food insecurity, along with the high cost of basic necessities, really weighs heavily on households, especially in urban areas like Lagos and Abuja. These dynamics are, crucial if Nigeria is to reset its growth trajectory toward more inclusive and sustainable prosperity. If you found this interesting, please subscribe and hit the like button. Let's talk Africa.